Warren Buffett has beaten the market for over 50 years using one simple secret that 99% of investors completely ignore. And by the end of this video, you'll know exactly what it is and how to use it yourself. I'm going to reveal his number one stock picking method, show you real examples from his actual portfolio, and give you the exact framework to find these winning stocks yourself. So make sure to hit that subscribe button, because this could literally change your financial future. Most investors pick stocks completely backwards. They look at the price first, then try to justify why it's a good buy. They chase hot trends, follow stock tips from social media, or buy whatever's making headlines. But here's what's crazy. Warren Buffett does the exact opposite. While everyone else is looking at stock charts and price movements, Buffett focuses on something completely different. Something so simple that most people overlook it entirely. Warren Buffett's number one stock-picking secret is this: he buys businesses, not stocks. I know that sounds obvious, but let me explain what this really means. When you and I see Apple trading at $180, we see a stock price. When Buffett sees Apple at $180, he sees a business that makes iPhones, generates $100 billion in cash flow, and has 2 billion loyal customers. The secret is in his famous quote, "I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 10 years. Think about that. He's so confident in the business that he doesn't care what happens to the stock price day to day. So how does he actually pick these businesses? Buffett uses what I call the business owner test, and it has 4 simple criteria. Criterion number 1. Can you understand the business? Buffett calls this staying within your circle of competence. He famously avoided tech stocks for decades because he didn't understand them. He only bought Apple in 2016 when he realized it wasn't a tech company. It was a consumer brand company that happened to make phones. Criterion number 2. Does it have a competitive moat? This is Buffett's term for sustainable competitive advantages. Think Coca-Cola's brand power, or railroad companies that own the only tracks between cities. These moats protect the business from competitors. Criterion number 3. Is management trustworthy and competent? Buffett says he wants managers who think like owners, not hired hands. He looks for leaders who allocate capital wisely and communicate honestly with shareholders. Criterion number 4. Is the price attractive? Here's the kicker. Price comes last, not first. Only after he's convinced it's a great business does Buffett consider whether the price makes sense. His rule: price is what you pay, value is what you get. Let me show you how this works with real stocks from Buffett's portfolio. Coca-Cola, 1988. Everyone thought Buffett was crazy buying Coke when it seemed expensive. But he saw an unstoppable global brand with pricing power. That investment has returned over 2,000%. Apple, 2016. Wall Street called Buffett late to the party when he bought Apple. But he wasn't buying a tech stock. He was buying the most valuable consumer brand in history, with an ecosystem that keeps customers locked in. Seize Candies, 1972. This was Buffett's aha moment. He paid what seemed like a high price for a small candy company, but learned that great businesses can charge premium prices and grow for decades. Here's your action plan to start thinking like Buffett. Step 1. Make a list of businesses you interact with daily. Your bank, your phone company, the stores you shop at, the brands you buy. These are in your circle of competence. Step 2. Ask yourself, if I owned this entire business, would I be happy? Not the stock, the actual business. Step 3. Research their competitive advantages. Do they have something competitors can't easily copy? Brand loyalty, network effects, high switching costs. Step 4. Only then look at the financials and price. Is it reasonably valued compared to its earnings and growth potential? Step 5. Think 10 years out. Will this business be stronger or weaker a decade from now? The biggest mistake investors make is treating the stock market like a casino instead of what it really is, a marketplace for buying pieces of real businesses. Warren Buffett understood this 70 years ago, and it's made him one of the richest people in history. If this video helped you understand Buffett's approach, smash that like button and subscribe for more investing secrets. And if you want to see how Buffett picks the exact right time to buy these great businesses, check out this next video where I reveal his market timing strategy that's worked for decades.